Hey, what's going on YouTube? Welcome back to Tech Conversations. I'm your host Guillermo. It is November 29th. Hope you're all having a great day today. As you can see, Robinhood says I'm down $200 today. I'm actually up for the day. Not sure why the chart is showing this. But anyways, we'll see what the rest of the day brings us. Now in today's video, I want to talk about how we can make a ton of money both ways with this very cheap option strategy, very low risk strategy. So before I get into it, all I ask is that you guys hit the like button down below and subscribe, guys. It really helps out the channel. Now let's go over our goal here very quickly. So our goal here is to benefit from volatile price action in the underlying stock with limited risk, and again for a pretty cheap price, because there's going to be very low risk. And again, I stay away from strategies that have unlimited risk. I suggest you do as well. So the ideal situation here is you believe that the stock will drop in price due to, could be bad earnings, maybe some sort of world event happening, things like that. But you also believe that there's a chance that the stock might rebound. So you want to be able to make more money both ways, right? And so that's what we're going to be talking about here. And that's what this strategy will allow us to do. So what I want to do is I want to use ticker symbol UBER, Uber, for this demo. So let's go over to this stock. Keep in mind, this is just an example I'm showing you here. So please don't copy this exact same trade. Now, before we even go into the options, okay, again, there's always two important things we need to look at. Number one, we need to take a look at commission fees. Robinhood doesn't have any commission fees, so we don't have to worry about it on here. But there are some brokers that do have some high commission fees. The reason we need to take a look at that is because we are opening and closing multiple contracts that could eat away at your profit. The second thing we need to take a look at, since we're going to be selling options, and anytime you sell an option, there is risk of assignment. We want to avoid early assignment, which is generally related to the ex-dividend. So we always want to take a look if the stock has a dividend. If it does, we want to take a look at when the ex-dividend date is. We want to avoid selling options on the week of the ex-dividend. If you do, you want to close out 2 days before to avoid being early assigned. Uber doesn't have dividend, so I don't have to worry about it. But let's say we were using a stock that does have a dividend. Remember, you can go to NASDAQ.com. You can search for whatever stock it is. So let's say we were using instead ticker symbol T, which is going to be AT&T. We would go ahead and click on AT&T here, and then we would go ahead and click on dividend history on the left. And then this will tell us when the next ex-dividend date is. So we can take a look here at their history. The next ex-dividend date would probably be around, the first week of January or so. So if we were using this for the next week or two, we wouldn't have to worry about it. So anyways, let's go back here. Uber doesn't have a dividend, so we don't have to worry about being early assigned. So let's go over to the options for this stock now. So here is how this strategy will work. So first, we want to choose an expiration date, and we basically want, this event that's going to cause the stock to drop to happen before this date, right? So what I'm going to do is I'm just going to leave it as December 3rd. Let's say I believe some sort of event is coming up before then that might cause the share price of Uber to go down. So I'm going to leave this as December 3rd. Now we're only going to be using put options with this strategy. So I can go over here and go to puts. Now here's the very first thing we need to do. So if the stock does shoot up, right, for whatever reason, if it does rebound, right, because maybe the event doesn't happen that we're anticipating will happen and the stock shoots up in price, what we want to do then is determine what price it would go above by the expiration, right? So if Uber were to instead rebound rather than going down, let's say I think it would end up going above $42 a share. So what I would do is I would start there, and I'm going to sell one put option at that particular strike price. So I'm going to switch to sell here. And again, since I believe that if Uber were to rebound and go up in price, it's going to go above 42, I would go ahead and sell a put option here. And of course, this is going to be an in-the-money put option. You should be selling an in-the-money put option here. So remember, in the money is where the strike price is greater than the current share price for puts, right? They're also going to be more expensive. So we're selling an in-the-money put option here. Again, because we believe if Uber goes up, it's going to go above $42 a share. Now that we've sold this put here, right? Remember, we're getting a premium. That's how selling put options works. We get a premium. Here we're getting about $219 per share. There's 100 shares in each contract. So we're going to get about $220 for selling this put option. So we're getting some premium there. We're getting a credit there. So what we can do now is we can choose a further out expiration date. So let's just say I'm going to go to the very next expiration date, December 10th here. And what I can do now is I can use some of this credit that I'm getting from selling that put option, which again is about $219, and I can use this to buy some out of the money put options. So out of the money for puts is where the strike price is less than the current share price. So that would be all of these. So basically, I want to use this credit I received to buy at least 2 of these out of the money put options. It should be at least 2, but it can be 3, it can be 4. Really depends on kind of a couple of things. But again, you guys can always take a look at, how changing the amount of contracts that you're buying changes your profit and loss, things like that. So what I'm going to do here is I'm just going to go ahead and choose this one right here at the strike price of $38. So I'll go ahead and switch this to buy now. Since we're buying some out of the money put options, I'm going to buy this one here. This is going to cost $63, right? And ultimately what you want to do here is you want to buy some of these put options with the credit, but you still want to have some credit left over when you enter this transaction. So I'm going to go ahead and click here. And as you can see, this only shows that I'm buying 1 put option. Again, we want to buy at least 2. So I can go up here, go to custom, and then I'm going to go ahead and actually buy 3 here. So let's say I wanted to buy 3 of these. So as you can see, I'm still getting a credit. I'm still getting $30 here, which is what we want. We still want to be entering for a credit, but now we also have 3 of these puts that we're buying that are out of the money. We have this put that we're selling that's in the money, and we're going to get something that looks like this. Okay, so this is telling me my max loss is going to be around $55. Right now, here's why you need to use option strat, because this is saying that my max profit is $251, which is not true. In fact, even if you look at this graph, like all the way to the left, notice up here, it's going to say expected profit and loss $7,000 or so, right? If you take a look at that. So keep in mind, this is not always accurate. I've noticed that. That's why it's very important that you use option strat to visually take a look what your profit losses will be depending on the date, depending on what the price is, depending on changes in implied volatility, things like that. Let's take a look at what this trade visually looks like. Again, you shouldn't trust Robinhood's profit and loss chart. Sometimes it can be incorrect. So I'm going to go to long put here. By the way, this is the victory spread that we talked about a few days ago, but this is using it with puts, right? In the last video, I used it with calls. This is how you would use it with puts. And of course, it's a little bit different. This one is more bearish oriented. The one of calls is more bullish oriented, right? So let's go over here. Again, we're choosing ticker symbol UBER, which is Uber. First thing I'm going to do here is I'm going to go ahead and add an expiration. And basically what we want to do here is you want to start with selling a put. So I'll click on this. I'm going to sell a put here. Make sure this is using the front month expiration, which it is. And we chose December 3rd for that. And so remember, we sold a put at the $42 strike, which is right here, right? That's where we sold our put here, because we believe that if Uber were to instead bounce up, it was going to go above $42. Then we went ahead and we bought 3 put options using some of this credit. Remember, we chose December 10th for that expiration. So we'll go ahead and add option. We'll do buy put here. And then make sure that we're using the back month expiration. So use back month here. So there we go. And then we went ahead and bought 3 at the 38 strike. So here's the 38 strike. And again, we want 3 of these. So 3 right there, right? And so again, we want to make sure we're still entering this for a credit here, which we are, $26. That's basically what allows us to make money if the stock bounces up instead of going down. As you can see, our max loss here, most we can lose, $56, right? Not a horrible risk. And then if we take a look here, max profit, a real max profit is $7,226. And of course, that's going to be if Uber goes all the way down to $0. So the more this drops, the more we can make money. We can take a look at that here, right? If it were to drop to $28, we'd make about $1,600. But if Uber for whatever reason instead bounces up, we can still make money on the upside, which is what makes this a really nice strategy here. And then, of course, we can take a look at our break evens. So on the downside, 37.46. On the upside, 41.01. So basically, we don't want this stock to trade sideways on expiration. We want it to have either gone above 41.01 or dropped below 37.46. Keep in mind that it's at $40 right now. So again, this is the victory spread with puts. It is a form of diagonal put spread. It's kind of a specific case of the diagonal put spread here. But ultimately, this is what it looks like. And of course, we need to take a look at what changes in implied volatility due to this strategy. So implied volatility drops. As you can see, we would not want that to happen. If implied volatility starts to go up, that's what we would want to happen in this scenario, right? So we do want IV to go up. We don't want it to go down. Now, the other big thing, of course, that I need to mention here is what happens on the expiration date. What should you do? Because on the 3rd here, the put we sold, of course, is expiring, but the puts we bought don't expire yet. So I personally like to just close out of the entire trade, right? I would close the put I sold, I would close all the puts I bought, and I would hopefully go out and take my profit. Now, you can certainly just close the put you sold and let the 3 puts you buy ride out, right? If you're still bearish on the stock, you still think in the next week or whenever this expires, the stock's going to drop even further, might make sense to keep the puts. But I personally like to just close out of the entire transaction at that point when my put that I sold is expiring. And of course, take a look here from a profit and loss percentage standpoint. You can see some really big returns, right? Even if it goes up, right? You can make potentially 250%, 170% returns. If it goes down, even higher returns, right? We're talking about potentially 1,000, 2,000% returns, 5,000, depending on how much the stock drops. So again, this is the victory spread with puts. Very low risk here. You can make money both ways. And so definitely a strategy to take a look at. Keep in mind, this is a more advanced strategy. So make sure that you have experience with options before jumping into this one. But anyways, if you have any questions about anything I just talked about, feel free to leave them in the comment section below. Check out the Discord, link to it in the description below. Hope you enjoyed the video. Let me know what you guys think, and I will see you guys next time.